Gold has been testing the $4,500 level repeatedly this week, and the reason behind the move is not as simple as the headline makes it sound. There are 6 things you need to understand about what is happening to gold right now, including the piece of labor data that shifted the market, the rate hike probability that is now at a multi-month high, and a specific chain of events that is making gold behave in the opposite way most viewers expect. This is not about predicting where gold goes next. This is about understanding what is actually moving the market right now. Gold has had an extraordinary 12 months. The price climbed from around $3,865 in October 2025, crossed $5,000 for the first time in history in January 2026, and reached an intraday all-time high near $5,600 before the end of that month. Since then, the price has pulled back significantly. As of June 3rd and 4th, 2026, gold has been trading in a range around $4,450 to $4,510, repeatedly testing the $4,500 level from both sides. That is still more than 30% above where gold was a year ago, but it is also roughly 20% below January's all-time high. And right now, investors are watching the $4,500 level closely. Not because it is guaranteed to hold or guaranteed to break, but because it represents a concentration of competing forces that the market is actively working through. The question most viewers are asking is a simple one. Why is gold not going up when there is so much uncertainty in the world? 6 points answer that question directly. Gold prices fell below $4,500 per ounce on Wednesday, June 3rd, 2026, extending losses from earlier in the week.
Yeah, I would say pipe, I mean electrification. You might want a second one just in case. So, for every one of those bullet points requires an enormous amount of copper. A data center might be built in 2 years, but the transmission system could take far longer. This is where the acceleration is occurring. So I'll pause there. Is there anything I need to clarify?
No, I'm just curious also about the stockpiling part, right? Like, I'm really trying to understand, okay, where's also the ceiling for everything? If it's strategic, then price doesn't matter, of course, David. So I'm curious, like, where do you see a ceiling?
Well,
Kitco News reported that gold was struggling around the $4,500 level following the release of U.S. labor market data. The Wall Street Journal reported that COMEX gold settled at $4,475.80 per ounce on one session, before edging back toward $4,505 in subsequent trading. $4,500 has become what market analysts call a psychological level, a round number that traders, institutions, and market participants pay attention to simply because so many people are watching it at the same time. When gold breaks below it, that tends to attract attention. When it reclaims it, that also attracts attention. Right now, gold is sitting in the range just around that level, pulled in opposite directions by a set of forces that are genuinely competing with each other. One important point of context: even at $4,462, gold is still more than $1,100 higher than it was a year ago. This is a pullback within a much larger move, not a collapse. On Tuesday, June 2nd, the U.S. Bureau of Labor Statistics released its latest JOLTS report. That stands for Job Openings and Labor Turnover Survey. The data showed that U.S. job openings increased by 731,000 to 7.618 million in April 2026. That was the highest level since November 2024, and it came in well above market expectations of 6.88 million. Layoffs declined at the same time. What does a jobs report have to do with gold? The connection runs through interest rates. When the labor market is strong, the Federal Reserve has less reason to cut interest rates to support the economy. And when interest rates stay high or go even higher, gold faces more competition, because cash and bonds start offering real returns that gold, which pays no interest or dividend, cannot match. Some analysts noted that the stronger labor data could weigh on gold, as the resilient labor market gives the Federal Reserve room to focus on persistent inflation and potentially keep rates elevated for longer. This is not a guaranteed cause and effect, but Tuesday's JOLTS release was the most immediate trigger for Wednesday's pressure on gold. This is where the story gets more significant. At the start of 2026, markets were pricing in multiple Federal Reserve interest rate cuts before the end of the year.
Says, don't you dare drink financial planners' Kool-Aid when they tell you U.S. bonds are safe. There is nothing safe from stupidity. Remember, now this is a warning, remember, even gold, silver, and Bitcoin can cost you money if you purchase on hype. When the hype cycle is high, we're going to talk about why that is working in our favor right now in 1 second. But he says, this is where it gets interesting. Don't buy on hype, but number two, it's best to watch cash flowing. Today, many major U.S. bondholders, remember the Kool-Aid from the financial planners, bonds are safe, bonds are safe. But when we look at what's going on today, many major U.S. bondholders like Japan, China, are dumping their bonds and more. And what are they doing? They're buying gold.
That expectation has now completely reversed. According to CME Group's FedWatch tool, the probability of a rate hike to the 3.75, 4.00% range now stands at approximately 38% as of June 4th, 2026, down slightly from over 41% a few days earlier, but still at levels that represent a meaningful shift from where expectations were even a few months ago. CNBC reported in mid-May that traders in the Fed funds futures market were pricing in a December hike at a nearly 51% probability. The Federal Reserve held its target rate at 3.50 to 3.75% at the April 29, 2026 meeting, citing inflation that remains elevated partly because of higher global energy prices. The mere fact that a rate hike has entered the conversation represents a significant change from the environment at the start of this year. Gold does not pay interest or dividends. When the rate available on cash and government bonds rises, gold becomes relatively less attractive. That is not a theory. It is a straightforward market mechanic that has played out consistently across multiple historical periods. This is the part that most viewers find counterintuitive. Gold is traditionally described as a safe haven asset, something investors turn to when they are nervous about the world. So why is gold struggling right now, during a period of genuine global uncertainty? Morgan Stanley analyst Amy Gower explained it this way, as reported by Euronews. With the conflict triggering an energy supply shock that has reduced hopes for lower U.S. interest rates, it is not surprising that gold has struggled to work as a safe haven this time. That is a precise and important statement. The current global uncertainty is not producing the usual safe haven flows into gold in a clean way, because the same uncertainty is also driving up energy prices, which is feeding inflation, which is keeping the Federal Reserve in a restrictive policy stance. The inflation and rates channel is currently overpowering the flight to safety channel. This is what Derek Ned, CEO of Ridgemont Metals, described to CBS News as the Fed being trapped. April's inflation came in hot. Markets have priced out rate cuts. Some traders are now betting on a hike. And in that environment, even genuine fear in the broader world is not enough to override the structural headwind that high rates create for a non-yielding metal. Energy costs are doing something unusual in this cycle. Normally, when energy prices rise, inflation rises, and gold benefits because investors look for stores of value that hold up against a weakening currency. That logic is still present, but it is being canceled out by a second effect. Rising energy prices are also making inflation harder to control, which means the Federal Reserve cannot cut rates and may need to consider raising them instead. Market analysis described this dynamic as oil-driven inflation fears reaffirming Fed hike bets, identifying energy prices as the core mechanism behind gold's pressure this week. The result is a dual effect that puts gold in a difficult position. Inflation fears argue for gold. Rate hike fears argue against it. Right now, according to the data this week, the rate hike side of that equation is winning. This does not mean energy prices will stay elevated indefinitely, or that the inflation picture cannot change. But what is confirmed right now is that elevated energy prices are feeding into the rate expectations that are weighing on gold this week. Investors are now focused on Friday's non-farm payrolls report for further clues on the trajectory of monetary policy. The non-farm payrolls report, released on the first Friday of each month by the Bureau of Labor Statistics, measures how many jobs the U.S. economy added or lost in the previous month. It is one of the most closely watched pieces of economic data in the world because it directly influences how markets think about the Federal Reserve's next move. If Friday's number comes in strong again, similar to the JOLTS signal from Tuesday, that could reinforce the case for the Fed staying hawkish, which would maintain the current pressure on gold. If the number disappoints and shows weaker job creation, that could shift rate expectations in the other direction and potentially give gold some relief. What the number will actually be is not known yet. That detail has not been confirmed. After Friday's report, major scheduled event is the FOMC meeting on June 16th and 17th, 2026. While a rate hold is widely expected at that meeting, the current probability of no change is near 99%. The language of the statement and the tone of the press conference will be watched carefully for any signal about where rates go next. Here is what is confirmed this week.
Central bank buying eased to 850 tons in 2025 after 3 consecutive years of net purchases above 1,000 tons. Key buyers included China, Poland, Turkey and India. In a surprising twist, the ECB identified stablecoin issuer Tether as the single largest gold buyer in 2025, acquiring more than 100 tons. A crypto company is now outbuying the world's major central banks in gold. Tether purchased 6.5 tons of gold in March quarter this year, bringing its total holdings to a record 132 tons. Over the last 6 quarters, Tether bought roughly 73 tons, nearly 50% more than China's central bank. In September quarter last year, Tether was the single largest gold buyer globally, bigger than any central bank. Why? Tether buys gold to diversify reserves, build resilience and back its stablecoin. With projected profits of $15 billion in 2025, analysts say Tether could add 50 to 60 tons per year without affecting operations. The new gold king isn't a country, it's stablecoin. Still, despite gold's rise, dollar-denominated assets overall still command the largest share of global reserves at 42%.
Gold has been trading around the $4,500 level, a recognized psychological threshold that the market is watching closely. The JOLTS labor data from Tuesday came in significantly above expectations. The CME FedWatch rate hike probability is near a multi-month high. Energy prices are feeding an inflation dynamic that is keeping the Federal Reserve in a restrictive stance. And that combination is creating pressure on gold that is, for now, outweighing the safe haven demand that global uncertainty would normally generate. What is still unclear is how Friday's jobs report will affect rate expectations and whether the current energy and inflation environment changes meaningfully before the FOMC meeting in 2 weeks. What is not in this video? A prediction about where gold goes next, a recommendation about what to do with money, or a claim that any of this is guaranteed to continue. This channel covers what is happening and why, not what you should do about it. Gold is still up more than 30% year over year. It is also more than 20% below its January all-time high. The market right now is working through a genuine conflict between 2 competing forces, and the data point that could shift that balance arrives on Friday. Which factor do you think is having the biggest effect on gold right now? The rate hike expectations, the energy prices, or something else? Leave that in the comments below.